Ken Shinoda, DoubleLine Capital Portfolio Manager, joins us right now as we kick you off to the close. And Ken, a lot of talk right now about the moves in equity markets, but a big move today, a surprising move, if you will, in the Treasury space, 11 basis points higher on a 2-year yield. What caught you by surprise?
Well, I think Powell put it really well. When you're driving in the fog, you might need to slow things down. And without data, they are in the fog right now. And I think that takes a potential cut, not necessarily off the table, but they're going to want to see some more data before they make their decisions.
Have you gotten any sense here, Ken, either from the statement today or the press conference, that the rate cutting cycle that everyone had pretty much priced in over the last couple of months here, that is still relatively intact?
I definitely think the rate cutting cycle is intact. It's just the speed at which they cut rates is going to be dependent upon the push and pull of inflation staying sticky and the labor market weakening. I mean, there's less people coming to the workforce, but as of now, unemployment rate's still low, and I think that's kind of holding the economy together. So they want to cut rates, but there are no race to.
Mm-hmm. No race to, especially you said that we need to see more data. The government still isn't open, so it's not like we're getting that official government data that might inform the path forward and might clear up some of that fog, Ken. I do want to talk about how you bring that into the portfolio. As Romain mentioned, you saw that big pop up in short end yields. And when you think about the curve overall, does this change your thinking?
No, we've been negative on the long end of the curve. We've viewed that fiscal risks, too much deficit spending could potentially hurt the long end of the curve. We're definitely more constructive on the front end, and even more so now with this rate move. I think it's given investors an opportunity to buy, some credit assets at the short end of the curve that have attractive carry and don't have to carry too much interest rate risk. So, I think maybe a buying opportunity on that front end of the curve.
And so we're talking about duration. Let's talk a little bit about credit risk here and go to the credit market, because you write in your notes, actually, that when you take a look at both investment grade and high yield, both of those asset classes, they're behaving more like the equity market right now. Ken, what exactly does that mean?
Well, they're definitely more correlated with the stock market. When stocks are doing well, credit spreads are usually come in, and credit spreads have come in a lot. Investment grade corporate bonds and high yield have had some great performance. Investment grade spreads are near, decade-long tights, even high yields in that same space. But I think the risks are a little bit lower in those two particular parts of the corporate credit markets. Where you're starting to see some signs of trouble in the last couple of weeks has been in bank loans, and we think pockets of the private credit markets where more of the risky borrowers have gone to over the last couple of years.
I am curious on that. I mean, Powell was asked about that, at least publicly. He does not seem to be concerned. And of course, we've asked pretty much every guest about this over the last few weeks, Ken. Is there a sense here that if there is indeed some material risk bubbling up, is that going to be confined, or do we need to start talking about this idea of systemic risk contagion?
No, I think when people talk about systemic risk, I think about the banking system. And I think the banking system has done a good job cleaning itself up for the last 10, 15 years post-GFC. And then it's in a good spot. You could actually argue that they should be more aggressive in expanding balance sheets to help the economy go along. So I think a lot of this stuff's kind of moved off balance sheet. A lot of the risks are off balance sheet and in private pools of capital. So I don't think it's a systemic risk, but there's going to be a default cycle. I mean, there's borrowers that are going to default. Doesn't mean that there's, a million cockroaches out there. Everyone seems to be talking their own book these days with these cockroach analogies. But, I think just investors should tread cautiously, know that there is risk in, below investment grade credit and allocate appropriately.
Well, it does seem like the war of words when it comes to the big banks versus what private credit firms are saying certainly continues, Ken. But to your point that we're going to see a default cycle, it sounds like you're preaching quality here, that you're not reaching down the risk spectrum necessarily.
With spreads as tight as they are and the credit curve so flat, meaning you don't get paid as much to take additional risk, we definitely like going to higher quality parts of the market. Agency mortgage-backed securities, they've done well recently, but they're government guaranteed, quasi-government guaranteed, and they can give you some interesting downside protection. So we think you should look to kind of diversify away from corporate credit into other parts of the bond market.
I am curious, Ken, before we let you go, I just want to get your thoughts here on the, I guess, what is effectively the end of quantitative tightening. I mean, assuming they don't restart it up again here. Does that actually matter to you?
No, I think that they're doing that because it's, if they're lowering rates, ending QT is just another way to ease policy. You're also starting to see a little bit of stress in the repo market, so I think they want to battle that. It's not really going to change much for investors in mortgage-backed securities. On the margin, they're going to take the dollars that are coming back from their MBS book, they're going to recycle that into short-term treasuries. So I think it's kind of a minor event for the bond markets that I traffic in, and I think it's a good thing for those short-term repo markets.
Ken Shinoda, portfolio manager over at DoubleLine Capital.